So it's one of the rare investments out there that give you this massive upfront tax savings and deduction in the first year, give you a very high yielding investment that's also quite tax efficient.
Got it. So if I'm so you're looking at 90 cents on a dollar in depreciation in year one. You're looking at additional 10 cents that's on amortized from year two through six. And you're also looking at a 20 cents in depreciation because of the depletion allowance. So all in, right, every year when you're taking an income stream, right, that's coming out of the fund, a lot of it, right? Again, how depending on the income, right? You're looking at a decent amount in first couple of years, right? Or in first year, where a lot of the income is just deducted, right? You're not paying taxes on because of the depletion allows, and plus the depreciation that's coming from year two through six with the depreciation
You
schedule.
got it. And that continues all the way through depletion. Like it doesn't stop after your basis reaches zero. The
Yeah,
depletion allowance continues all the way through the life of the fund.
got it. And in terms of over the life of the fund, right? Let's call it 10 years. That what we talked about. And I know we talked about that. Historically, we have seen people getting their money back over the course of 4 to 5 years, just cash and cash return purely. What have you seen historically, right? Over the course of 10 years, people getting, I don't know, 120% or 30%. What are we talking about here?
Yeah. So when we structure these funds, right, we invest in these assets. Our model, right, we won't even put an asset into the fund if it doesn't try to deliver a 1.5 to a 2x over the life at current prices, right? So kind of when we structure these investments on $100,000 investment, we believe over 10 years we can get 150 to $200,000 back in cash flow over the life of that fund. And that is not including that $45,000 of tax savings you took in the first year. Right? Some funds will do better than that if prices go up during that 10-year period, and some funds may underperform a little bit if prices retract from that point for the 10-year period. But when we structure them in the year, that's our target and that's what we're focusing on.
Got it. That's pretty good when I think about this, right? Depreciation plus 150 to 100%. Again, nothing guaranteed, but it's a
Yep.
pretty decent return. Essence of time. There is another that I think is a big value proposition, Nick, is a preferred return. Now, if you were to explain to someone in a very simple terms what is a preferred return and how it is actually a value proposition to an LP or even a GP, right? How would you explain it?
Yeah, I think the easiest way to explain it is when you're investing with a company, you want to make sure that the GP and the LP interests are aligned, right?
Got it.
That in order for the GP to earn fees and revenue, that the clients are earning the rate of return that is expected, right? And so we've structured the investment to try to do that. And so the preferred return, U.S. Energy earns 15% of all revenue coming from the fund on a quarterly basis,
Got it.
unless we're not hitting at least a 12% annual rate of return for clients. So let's say oil prices fall, right? And revenue drops from 20% to 11%. Well, we're not entitled to any of those fees, right? We forego all of our fees, 100% of all revenue goes to clients to get them above that threshold. So our interests are aligned. In order for us to continue to grow, which we have been over 45 years, and earn revenue as a company, our investors need to have performance. Our investors need to get a decent rate of return as well.
Got it. So if I'm understanding this right? So GS Energy is not gonna make anything unless the LPs are looking at a certain return. And that certain return, depending on when you are investing, right, could be 20% a year for 5 years. So that means US Energy is not going to make anything unless I make my money back, right, over the course of 5 years, right? It's just, I know it's divided over the course of 5 year or 20 years. So if you're not hitting above 20%, I'm essentially going to get my money back, and then US Energy, and this is sort of I think serves as a, I don't know, catalyst to perform better and everything.